All right, we will now start the webinar. And good morning to everyone, wherever you are. Good afternoon and good evening, depending on where you are. Welcome to our webinar presented by the IAA Banking Virtual Forum. This is the first webinar of 2025. Our webinar today is on operational resilience in the financial sector. And I've got presenters here that I'm going to introduce. Dr. Robert Shannon. And Dr. Robert Shannon is the global head of Tata Insurance Consulting, and he is a member of the Institute and Faculty of Actuaries. Then you have got Lawrence Ababe, a distinguished actuary and a strategic risk advisor. He is also a member of the Institute and Faculty of Actuaries. And myself, some of you or most of you already know me. My name is Michael Ticharewa. I am the chair of the Banking Virtual Forum of the IAA. I'm a fellow of the Actuarial Society of South Africa and also a fellow of the Institute and Faculty of Actuaries. Now, you would have engaged with us as we present these webinars for a long time, and you potentially already know Nancy Kelly from the IAA and also Pandla from the IAA, who are sisters. Now, before we move on, I would like to hand over to Nancy for some housekeeping rules. Then I'll come back and say a few words before I hand over to Lawrence and Dr. Robert Shannon. Thanks. Over to you, Kelly, Nancy Kelly.
Thank you, Michael. Welcome everyone to the webinar. As we go along, the speakers will discuss various topics. If you find that you have a question or a comment that you'd like to raise, communication capability has been turned off, but please do put your questions or comments in the Q&A icon you've located at the bottom of your screen. And please note that a recording and a copy of the presentation will be made available on the IAA website following the presentation today within the next day or two. Also, a disclaimer, the views or opinions expressed in this presentation are those opinions solely of the authors or presenters and do not reflect the IAA or any other organization. So now we can begin.
All right. So thank you very much, Nancy. And, as we get started, the topic is often operational resilience in the financial sector. And most of you would be familiar with this. You'll be familiar with operational risk. And these speakers are going to speak to us, and they will use the United Kingdom as a case study. But the issues they are going to speak about are applicable across the world. The only difference being different regulatory requirements and different interpretations. So you can pretty much apply all of these to your own specific jurisdictions. But why is this topic important? The topic of operational resilience is quite important because it's really talking about the readiness of financial institutions. In our case, as the Banking Virtual Forum, we are interested in the banking space. But the speakers have actually done research to include the whole financial sector, looking at asset managers, insurance companies, and banks. So that's what they'll speak to us about. But disruptions do happen. And most of you know that if you can't use your credit card, if you can't pay, you can't move money. That's the most basic that you can understand, because there was a disruption. What's the story? What happens? So that's why this topic is extremely important. And in the UK, financial institutions are supposed to comply by March 2025. So that's what the speakers are going to speak about. The implications for banking financial institutions are great, are very large. The impact on customers that arise from there, the impact even on holding capital if you do not have an effective operational resilience framework. the impact. You won't have mitigating factors or plans in place, and the capital you need to have to hold as a result of not having that can be huge. So the implications are so big, they are so widespread. That's why this topic is important. So let's listen now to Lawrence and Dr. Robert Shannon. I hand over to you. Thank you very much.
Next slide. Slide, please. Okay, so thank you. So, no, can you go back one slide? Yes. Thank you all for being here, and thank you, Michael and Nancy, for the introductions. I hope you can hear me right. So in today's agenda, we'll start by just bringing up key definitions and principles. What's the meaning of operational resilience, and what are the definitions of the different components that constitute an operational resilience framework. We'll talk about the regulatory principles and basically the regulation that we looked at in order to develop and produce our paper. We look at issues related to why it matters and who it matters, and introduce an operational resilience scenario framework, which is basically the latest requirement by the UK regulators in order to test your risk assumptions and your risk judgment after you conduct your risk analysis, to test your impact tolerances and basically your operational resilience and financial resilience profile to basically continue operations under any sort of disruptive event. And lastly, we'll look at conclusions and recommendations, and we'll take some questions. Next, please. So what is operational resilience? Well, this is operational resilience. You can think of it as the basically ability of financial institutions. And when we talk about financial institutions, we're talking about banking financial institutions and non-bank financial institutions, meaning covering sort of hedge funds and asset managers and insurance and pension funds and banking sort of institutions. And the idea is for these particular sort of institutions to be able to withstand any sort of disruptive event, irrespective of the type of shock, and basically make sure that they are able to continue to provide the services they provide to their customers without interruption. And I think the reason for this particular framework is due to the experience that we had during the COVID-19 pandemic, where there were many failures sort of during that particular period to provide services to customers, and the issues that followed after, particularly with the failure of customers of a couple of banks in the UK to access their money, and the CrowdStrike sort of software update that led to significant disruptions in millions of computers worldwide. The operational resilience framework has certain components. The first component, in order to implement the framework, you need to identify your important business services, basically what service you're giving to your clients, and that would depend if you are a bank or a non-bank financial institution. You need to identify also the reliance on critical third-party service providers, and then you need to be able to set impact tolerance for disruption, meaning that you need to be able to test your risk assumptions under different sort of disruptive scenarios and make sure that your impact tolerance, could be the outage time or the number of clients impacted, does not exceed the regulatory risk appetite and the internal board approved risk appetite. And then you need to do a mapping between the external dependencies and the internal processes and systems and people that are maintaining these sort of operations under any sort of severe disruption. So for an operational resilience framework, as I said, we need to identify the important business services, we need to set impact tolerances, and lastly, we need to come out with plausible and severe range of scenarios to test those risk assumptions. Next, please.
And Lawrence, I'd just like to add on that last point, a couple of things that have brought on this new regulation from the different regulators that we studied in our paper. It's the chronic underinvestment in IT. And it's just been going on for many years. It's seen as IT as just a tool, but we need to basically spend as least as possible on it. It's not really important, but due to the digitalization of our businesses now, especially in banking, generating financial services, IT has become the tool that we actually rely on. So that this has driven basically the regulators to think about, well, let's dust off our regulations from Basel II and from the FSA back in 2006, and we need to look at this again, and hence the PRA and the FCA have brought on new regulations, market leading, but also this has been brought on by other countries as well. I'll let you I'll let you comment on this slide, Lawrence. Just want to add that.
Oh, thank you. So we based our sort of paper on the key principles that which is basically the guidance text from the Prudential Regulation Authority and the Financial Conduct Authority, and we have sort of looked at specific statements of policies concerning IT for important business services and the critical third parties paper that came out in 2024. We also looked at the European Union requirement in regarding to information technology directives, the NIS2 directive that was published in 2022, and the DORA Act. We also explored operational resilience sort of guidance in other countries, Australia, Canada, and Singapore, and international guidelines covering ISO 22301 and 31000. Next slide, please. Robert, would you?
Yeah. So, what matters and what are the key issues, and how do you successfully drive that change? Well, as a risk manager, you'll probably know you're probably very enthusiastic to improve your risk management framework, but if you look back at ISO 31000 and the importance of organizational risk culture as as that relevant internal content to design an effective risk management system, you will see that risk culture is absolutely key. Without risk culture and without the support of your board, principally the CEO and the non-executive directors supporting that change, it is very difficult to support that change because that tone from the top coming from the board supporting that change and messaging that this is the direction in which we want to go is absolutely key to supporting the change that you are trying to achieve. Okay, because it starts from the top and ends right at the in every employee is effectively an actor in making that change. So, looking at that, those prevailing attitudes, those values and behaviors are key on how employees approach risk and making that framework work effectively. Okay, so couple of things that I wanted to bring up and many of the benefits of a good risk culture. So principally, it goes through, in risk management, improved decision making, enhanced reputation, a competitive advantage, and reduced risk of disruptions is what the regulator will be looking at, and risk cultures is really part of that. But also from now we are so much customer orientated and focused. It's an enhanced service quality that the customer will appreciate. The second thing is risk appetite. So this is absolutely key on looking at your risk appetite framework and your capacity to accept risk. So how much risk can we actually take on, and how are we going to mitigate this? So your risk appetite framework is key in actually determining, one, how much risk can you take on? Secondly, your ability to recover, because your controls and your mitigating actions. But also you must think about from the wider risk management framework. So crisis management, for example, your business continuity, and also disaster recovery are also key in making this framework work correctly and effectively. And this is why in the paper I decided to talk about the importance of building an information technology foundation for managing IT risk, because now your business is based on IT. Without IT, nothing would work. And ISACA actually gives us a very good basis to start with. It's not the panacea, but it's basically a very good basis to start with. And in this framework, you'll find about 50 different set scenarios which you could use within your organization. And this is this diagram comes exactly from that. So it looks at scenarios and loss events, the actor and threat community, the intent, the motivation, the threat intent, the asset and the source. When it comes to the IT asset and the resource, the effect and also the timing. So if you combine the information technology foundation with COBIT 5, then you have that strong basis on which to build your operational resilience framework. Next slide. So here it is. So again, from ISACA, this gives you a direction in which to go to look at your business objectives. So top-down scenario identification of your business objectives. You identify your scenario with impact and achievement on those objectives. So those are your business objectives. And then you can also have generic risk scenarios for IT, where you might identify all your hypothetical scenarios, and also reduce these through high-level analysis. So that will give you a refined and specific IT risk scenarios, working that through with an estimated frequency and impact, and that will give you an overall framework for your IT. So underneath you'll find your risk factors. So your external risk factors, your internal risk factors, your risk management capability and capacity, your IT capability, and IT-related business capability. I think there's only one thing risk missing from this diagram, which we talked about earlier, is your risk culture. Now, in IT, there's not very much risk culture. They are risk aware, but going from where they are now to being much better risk managers, there's normally quite a big step. So there's normally quite a lot of hand-holding. And I've been in organizations, even on a project I'm working on now, where you know, they haven't implemented COBIT 5, for example, not even COBIT 1. So there's a little bit of time lag. So you may have to hold their hand and say, well, look, I'll design all of this for you. And then we can meet and then we can discuss on the changes that we need. So that handholding is really important because you cannot just give them the framework and implement it. You've got to work with them, you know, and get them on your side. So next slide, please. I put this because in my reading, I read this a while back in the IT risk pyramid from Westerman in 2005. Unfortunately, his book is out of print, so you may be able to you get this in as a used copy, but it gives you a very good framework in very simple way. So this pyramid starts with, well, your IT system must be available. If it's not available, then you can't do anything. If it's not accessible, well, again, as it goes accessibility and availability, it must be accurate, and that gives you then the agility to change things within your IT system. So you're always updating systems, you're taking away legacy systems, but without all of the bottom three, you can't achieve the top. So next one. And we talked about risk culture, but also the risk maturity model is really important. So if you're starting at repeatable, these are the different steps that you may want to use to move up that risk maturity and the operational risk maturity. So I quite like this this Carnegie Mellon risk maturity model. There are others. There are thousands out there, but this one gives you an idea of first of all, the capability attributes that you're looking to achieve, but also the method of achievement. So in a lot of banks, up to now, I've experienced that we've got up to repeatable. So there is a common language, there are defined tasks, but have struggled really to get even to the managed part. There are some banks that are good at it, some are not there. They're still struggling at the repeatable or defined. So if you want to make your operational resilience project work and successful, you must work through risk maturity and work up that risk maturity curve. Next slide. So, Lawrence, is this me or you?
Go ahead, no, continue. That's you.
Yeah, that's me. Okay, so who matters? Well, consumer duty and conduct risk are also critical elements of operational risk, and we've seen this throughout the UK. It started off with treating customers fairly, has evolved with conduct risk, where it involves the risk of inappropriate or unethical or unlawful behavior by the firm's employees or management. And it includes within that products as well. And that has evolved also into consumer duty, where financial firms must act in the best interests of their customers. There's no more Wild West out there. But if you don't consider consumer duty as part of your operational risk, you're missing something. Because everything now has become customer centric. So when you build your operational risk resilience framework, it must be customer centric. It must be towards the customer and making that customer happy. So this is why we've looked at the interrelationship between the customer-centric operational risk system and conduct risk. We've designed a 3 pillars of identity to respond and react, recover, and learn, because we are now orientating everything towards that consumer, and this is based on the foundation of physical integrity, IT, and cybersecurity. So it all comes together. So in the next slide, you'll see that this pyramid now, which we publish also in the paper, you got the base of the integral physical IT and cybersecurity. So as I said, digitalization has brought this on, but also now you've got these 3 pillars. You've got to identify and prepare, respond and react, and recover and learn. And these are your basic pillars for your centric operational resilience structure. On top of that, conduct, risk, consumer duty, which must be your main beam. And that constructs then your whole house of your customer-centric operational resilience framework. Building this is not easy because there are loads of steps to this, and first taking this to the board and convincing your board is not an easy task because it costs money. And as I said, one of the main issues that I've come across in my consulting years is IT. The legacy systems, the low investment in new technology. Now that's partly being resolved with the investment in AI, because everyone wants to get onto the AI bandwagon. But you'll still find out there some systems which are underinvested in, and that's going to hinder your operational resilience. Next slide. Lawrence, this is you.
Yes. So thank you, Robert. So in this particular section, we'll basically introduce the operational resilience scenario framework. And that's quite important because this particular framework will allow us to test our risk assumptions that we arrive at from the operational resilience risk assessment process. So just to remind ourselves, with the operational resilience risk assessment process, or let's call it the framework, let's take a sort of an example. So the first component here is that for any financial institution, let's say, for example, a bank, you need to identify your important business services. And these sort of, for a financial institution, they have many business services that are important. One of them would be the payment. So basically, that's what you provide your customers, how to conduct payment, whether through withdrawing cash through an ATM or transferring money online. So the payment process would be an important business service. The second step is you need to basically identify your critical third-party service providers. And you need to think in terms of a financial ecosystem. So you are one financial institution in this particular financial ecosystem, and you have connections to critical third-party service providers that are providing, for example, the plumbing for the institution to be able to conduct its daily activities without any interruption. Those critical third-party service providers, they can be, for example, your telecommunication service providers, they can be your iCloud service providers, they can be your technology service providers, they can be your credit card processing service providers, and they can also be, for example, your what we call the central counterparties, who are engaging with basically financial institutions and non-bank financial institutions to do clearing and settlement of financial derivatives that are transacted between all these sort of financial institutions within this particular ecosystem. So after you identify your important business service, and you identify the connections you have to critical third-party service providers, you need to basically assess the impact tolerance or the impact for disruption. And for this particular point, the way you need to approach it as a financial institution is that you need to basically designate the important business service. We said for a bank, one of them would be a payment process. You need to, the second stage would be to look at what are the regulatory requirements regarding the disruption to this particular business service, and look at what is the regulatory risk appetite. So, for example, regulation requires that all payment processes to be conducted within 48 business hours from inception. So that would be your regulatory risk appetite. The third stage would be to basically engage with your board in order to assess their risk appetite. Of course, no one wants to basically have any regulatory breaches. So that would be also the risk appetite for the board, which is 2 business days. The third or the fourth component of setting up the impact tolerance would be to look at some historical scenarios and historical narratives whereby a similar situation happens, whereby this important business service was interrupted for more than, let's say, 3 days. At that particular point, you need to assess what was the response of the customers. For example, for any disruption to payment processes. Historically, customers closed their accounts, they moved their businesses to other banks. Some investors did not fund, for example, the institution. And then you all use this information through your risk analysis and the assumptions. You use it to arrive at a conclusion, for example, that you want to set a business, you want to set an impact tolerance for this identified business process of no more, let's say, than 72 hours, which is 3 business days, and that is above the regulatory risk appetite and also above the board risk appetite. So the cutoff would be setting this impact tolerance for this important business service at, let's say, 72 hours. Now, of course, you need to take into account that anything beyond this particular impact tolerance risk appetite would create or would impact the safety and soundness of the financial institution, leading to possibly regulatory risks and legal risks. And it also leads to significant stress to customers because they're not able to access their funds. So that's the third stage of the operational resilience framework, where you set your impact tolerance. In order to test these assumptions and these judgments, you have to conduct scenario analysis. Now, that's what I wanted to talk to you about in this particular section. So how to develop those scenarios to test those risk assumptions? Well, we know that the process of risk preparation requires several stages. The first stage is you need to basically identify what can go wrong. Second stage would be to identify how these particular events impact your operational and financial resilience profile. You need to assess basically what are the what you need to do in terms of mitigating and preventing strategies to minimize the effects on the business, and how to basically prevent the event to lead to a situation where it disrupts one of your important business services, where clients or where customers are impacted for a prolonged period of time. And of course, that would require you to allocate resources in order to do the prevention and the assessment and prevention and mitigation. So you need to also, part of the risk preparation process, you need to speak to your board, basically, in order to ask them to allocate the sufficient resources for prevention and mitigation. And then you need to basically have a framework in place so that you can test those scenarios, whether live scenarios or desktop scenarios. Now, if we go go back to the first point, we said that we need to identify the range of issues that potentially can impact the operational resilience profile of a financial institution that leads to disruption to one of the more important business services. And this disruption basically can last for more, what we call the outage time, could be more than the regulatory risk appetite, and it could be more than the internal board risk appetite. So we need to look at a range of risks. And in this particular table, we have a classification of different types of risks. So we have the known knowns, for example, things we already know about. We know how they interact with the business. We can prevent them, or if we can't prevent them, we can mitigate, minimize their impact. So for example, a large-scale cyber attack, a direct cyber attack, or basically a failure of a particular IT component, similar to the event that occurred in July of 2024 with the CrowdStrike software update, where it impacted millions of computers worldwide. So we also deal with emerging risks. So part of the scenarios, we need to think of emerging situations whereby they have an impact on my important business services. So, for example, consider here a central counterparty. Central counterparties, they are buyers and sellers of financial derivatives. They act as a buyer for sellers and a seller for buyer, and they connect these financial institutions, whether they are banks or non-bank financial institutions, through these sort of clearing and settlement. So imagine, for example, a scenario where certain processes within these sort of central clearing counterparties are using AI-driven models to do the settlement and clearing. And imagine a malicious actor who basically targets those sort of AI-driven models and the damage or the adverse implications that it could create. So these are sort of emerging problems, for example, AI-driven trading models or anything that's AI-driven. And then we have a whole class of risks that we call the unknowns here. And in the industry, we call them the black swan events. And the black swan events is a name given to these type of risks according to a book that was published called The Black Swan, The Impact of the Highly Improbable. And the idea here is that we have certain class of events basically, that we cannot even imagine. But these particular events have certain characteristics. They are sudden, they are unpredictable, and unpredictable in a sense that they are, we don't know when they happen, we don't know how they happen, and we don't know where they happen. But when they do happen, they generate massive consequences or massive losses, whether they are quantifiable or non-quantifiable. At the same time, in thinking in terms of the risk assessment and arriving at a probability associated with those events, they tend to have a very low probability, meaning within my lifetime or your lifetime or anyone's lifetime, probably we see some of these events one or two times. So they have a very low probability. So these class of events basically are very disruptive. Now, next slide, please. Next slide. In terms of the common consequences, so we said that we need to look at a class of events that generate common consequences. And ultimately, we have at the back of our mind how these particular events will interact with different components of the financial ecosystem. We said the banks, the non-bank financial institutions, the critical third-party service providers, and how basically the risk will impact ultimately the important business services that a financial institution is providing. So, for example, if we take we take some examples, if we look at a particular event, these type of events, they generate similar consequences, meaning that they tend to drive or to create travel disruption. Sometimes these events create issues with critical infrastructure, for example, the electric power grid, a large-scale cyber attack on the electric power grid, where certain sectors of the economy stops functioning completely. These are the primary effects, and then they generate those sort of triggered cascading consequences as they rip through society. So, for example, they can lead to travel disruption, can lead to global travel disruption, can lead to strained supply chains that can lead to basically impacting the supply of goods and services, essential goods and services, for example, that can lead to other issues. For example, if there's not enough goods and services in the economy, it can lead to social unrest. The impacts could be unpredictable direction and unknowable magnitude. That in itself can lead to multiple issues leading to, for example, multiple bank runs where the financial institutions don't have the funds to basically give people the money that they want to withdraw. So you need to think in terms of the common consequences generated by a whole class of events that have those common consequences. When it comes to the risk assessment, the probability of, for example, thinking about these events discretely is very low. But if we think in terms of a portfolio of risks or unknown events that generate similar consequences, and the probability that we get any one of those events over the assessment horizon, obviously it's much higher than the probability of a single discrete event. Next slide, please. So we talked about basically the risk process or the process of risk preparation, how to identify what can go wrong, how to identify how to prevent and mitigate the effects, what are the resources needed. Now we need to look at basically developing a scenario framework that, as I said, tests our pre-assumptions regarding the important business disruptions to important business services, the disruptions to the impact tolerance, the acceptable levels of disruption, whether regulatory or internal, that is accepted before the event can lead to significant stress to customers. It can lead to reputational and legal issues for the financial institution, or in the worst case scenario, potentially it could be the disruption at a particular institution can be a trigger to the stability of the whole financial system. So as you see here in this particular depiction, the spheres in the middle are basically the financial ecosystem. And that financial ecosystem is composed of, as we said, the banking institutions, the non-bank financial institutions, and these are the insurance companies, the reinsurance companies, the hedge funds and the pension funds and the asset managers. And then you have the critical third-party service providers. And these critical third-party service providers could be, as we said, the iCloud service providers, the technology service providers, where the business depends on in order to conduct its day-to-day activity without interference. So in order to develop the reason that we use these sort of scenarios is because in times of high uncertainty and unpredictability, scenarios provide us with a means to consider a range of plausible but severe disruptions that are varying in nature, varying in severity and duration. And ultimately, the variation in the nature of the event, the severity and the duration will allow us to see how those particular events impact the service providers and the service users in the financial ecosystem. Examples of scenarios would be a failure of a specific IT component, or a failure of a single or a multiple critical third-party service providers, a large-scale cyber attack, for example, attacking the critical third-party service providers that are providing, let's say, 60 to 70% of the services to the whole financial system. For example, a loss of power to different sectors of the economy due to a terrorist attack. You have a wide range of scenarios that you can consider, but ultimately you need to map it back to how it's going to impact your important business services. Also, when we use those particular scenarios, it allows us to ask many what-if questions. So we can configure it in certain ways in order to arrive at a specific outcome. And it will allow us to identify the transmission channels Okay, this is very important. The transmission channels of the shock into the ecosystem, how it impacts the critical third-party service providers, how it could impact the critical infrastructure that's basically supporting the whole ecosystem and the economy, and how that can channel to the important business services that I provide to my clients. It can also give us and identifies the interconnections that exist not only between the financial institution and other financial institutions and non-bank financial institutions, but the connections I have with the third-party critical service providers and the critical infrastructure that supports the financial ecosystem. It also allows us to identify the dependencies and the full range of operational and financial vulnerabilities that potentially can arise due to these particular shocks. When we need, of course, just to sort of like recap, when we look at these particular scenarios and how those events can propagate through this financial ecosystem and impact, for example, a critical third-party service provider, whereby it impacts indirectly the financial institution, or a shock that impacts directly the financial institution, this kind of analysis, risk analysis, what allows us to map out. So we need to create a map. So the financial institution needs to create a map. Who are my critical third-party service providers? What are the critical infrastructure that I depend on? And we need to create that map in order to see the sequence of events that will lead to the most damage and basically lead to a disruption to one of the important business services that I provide as a financial institution. We said, for example, payment service or payment processing. Then there's a choice regarding developing those particular scenarios, in a sense, what kind of scenarios we're going to explore. We can have desktop scenarios, we can have live scenarios, and there's an overlap between the desktop scenario and the live scenario. Of course, live scenarios are more important because they provide a greater sort of depth of understanding, particularly to the challenges faced in times of crisis. But of course, this needs to be balanced with knowing that a live scenario would potentially create a disruption to clients for a prolonged period of time, maybe 2 days or 3 days, and therefore we need to think of other innovative ways in order to conduct those scenarios live. And a more important point here is that when we conduct an operational resilience risk assessment, we don't want a static risk assessment. We want it dynamic, because a static risk assessment looks at basically the probability of a discrete event happening. Okay, what's the probability we get another pandemic over the next year? Well, okay, if we use the frequentist approach, we say, okay, well, we got it 3 years ago, so the probability we get another one over the next year, given that we had it 3 years ago, is this. That's not sufficient, because risks don't happen discretely, they happen concurrently. You can have a large scale cyber attack attacking critical infrastructure. You can have war going on with its own implications. So we really need to map the compound effects of these sort of risks and how they come together in the financial ecosystem and amplify the effect. Next slide, please. So just to summarize what we said, the key considerations in building an operational resilience framework. So the first point is that it needs explicit management and a holistic view, meaning that you need to be able to map out as a financial institution your dependencies, your connections, and basically understand approximately the transmission channels of those events or those shocks, how they propagate through the financial ecosystem, impacting the important business services I provide. And that needs to robust risk analysis to look at the immediate effect and to look at the higher order cascading consequences that are generated by these events, and look at the likelihood that these events will impact the important business services that I provide to customers. The design of the scenario, as I said, could take into account varying levels of complexity. It could take into account varying levels of the nature of the scenario, the severity in terms of the quantifiable and non-quantifiable impact and how they impact my important business service, and the duration. Consider a range of risks and shocks. You can, for example, think of geopolitical risks, how a geopolitical risk can impact the operational resilience of a financial institution. One manifestation of a geopolitical risk would be a state-sponsored large-scale cyber attack targeting the most critical third-party service providers in a financial ecosystem or a financial system, providing the plumbing to the banking and the non-banking financial institutions. And in order to do that, you need basically an operational resilience framework. You need a robust process of risk preparation and risk assessment. And then you need to basically understand how to identify the different important business services, how to connect them to the internal processes, people, and systems, so that you are able to understand what to do to these to the people. I mean, in order to understand what to do in case you have a disruption. And then you need to set impact tolerance level, taking into account the regulatory risk appetite, the board's risk appetite, and the risk assumptions and judgments you need in order to basically arrive at the impact tolerance per important business service. And lastly, the scenarios, the live scenarios or the desktop scenarios that will test all these risk assumptions. Robert, thank you.
Next slide, please. So our conclusions and recommendations. So several areas which you could use to enhance your operational resilience and focus the attention and importance of solid information technology risk assessment and building on COBIT-5 and the ISACA frameworks. I would very much recommend you have a look at those. They are full of a lot of experience and a lot of knowledge, but they need to be really hooked up to ISO 31000. So that takes a little bit of work. Certainly, that's what I've recently done for a pension provider, for example. Consider your consumer centric organization and how you're going to build your operational resilience framework. And as Lawrence said, operational resilience cannot be done without a stress and scenario framework either. So the Bank of England and the PRA have put together a robust enforcement framework, and thus organizations must identify their level of operational risk maturity. And we've identified in our study that the issues that remain for further examination, and these are critical third-party risk management. Part of this can be solved through the old GDPR study that you may have in your organization if you are in Europe or you are in the UK, because there was a study of critical third parties with GDPR, especially if you're based in France. Climate and nature transition planning issues. We've not talked a lot about these in the paper, but these are also impacts to your operational resilience. So certainly the physical perils are something that you must also take into account. And also, lastly, because we've seen this certainly in banking and now also in insurance, recovery and resolution is your financial operational resilience as well, must also be taken into consideration. And that ties nicely with your risk appetite framework and your overall ERM framework. on how to introduce this concept of operational resiliency. Next slide.
All right.
Yeah. We've
References.
put some references for you. I really encourage you to read the paper. There's a lot more in there that we've had time to talk about. So especially the operational risk pyramid I talked about. I really summarized that rather quickly because I was conscious of time. But please have a look at the paper. You know, if you want to connect on LinkedIn, please feel free to do so. Ask questions, and yeah, there we go.
All right. No, thank you very much to Dr. Shannon and Lawrence, my esteemed colleagues. It's always interesting when we listen to people with the expertise in a particular area who have done the research. So thank you very much. And to our audience, I trust that you enjoyed this. We have got about 3 questions in the Q&A, but you know, just to comment here, you can see the importance of having an appropriate operational resilience frameworks that looks at everything. You know, I like what I heard that, you know, very often we do ignore the compound impact of independent risks that are correlated, that have dependencies that we ignore. And I like the comments from the speakers that this really requires a dynamic assessment of the risks, you know, so that you can understand, you know, instead of following a deterministic approach where you assume that risks happen discretely. And these are things that are important. And the point of risk appetite, which is a big topic on its own, you know, the regulator has got their own risk appetite levels, and internally the board will also have defined that you need to understand those so that you can set appropriate tolerance levels on what is acceptable and what's not acceptable, and even what mitigation measures you can put in place. So there's a lot that came out of this presentation applicable to banks, the banking system, but to the financial system itself overall, because you know, one institution failing or doing the wrong things or ignoring something can lead to systemic risk across the whole financial system. Just think of just one thing that you can't solve as a bank for 5 days. You lose confidence. There's a run on the bank. People come and take their deposits because you couldn't actually fix a problem that you should have put measures in place. That bank can collapse just from these things. So thank you very much. I think this is quite enlightening. Now I want to go to questions. There are not too many questions. One question was one I already answered, but I'll have to read it out for purposes of the recording. So with this week's Citigroup payment, this is from Francis Triong. With this week's Citigroup payment processing near miss, any opportunity for actuaries to further participate in the banking space? Look, I already answered that. Actuaries are already involved in operational risk. Also, operational resilience is really a part of operational risk. You would need to have as part of your ERM, you need to have an operational risk framework in place. There's a lot of things that happen, modeling that happens, scenarios that Lawrence and Dr. Shannon were talking about need to be developed. So actuaries can add a lot of value in that. I'm going to ask Lawrence and Dr. Shannon to come in later when I've gone to the other questions, so that if there is anything else you want to add, you can add. So I would like to move to the next question. 2 questions by Nikki. Nikki says, please provide an example of risk appetite in the context of operational resilience, which Lawrence has already touched on. But Lawrence, you can come back to that question if there is anything else to add, but you touched on that when you were presenting. You gave some examples there. Then the other question was, please provide an example of how to build resilience in the context of geopolitical cyber risk. So I think that's the question to start with. We only have got 1 minute. Maybe I can extend with another 2, but strict time. So we have 1 minute. Let's answer that question. Thank you.
Sure. So basically, for the second question, the first question is you need to be able to look at the regulatory risk appetite, and you need to assess your internal risk appetite for the tolerance of a particular disruption to one of your important business services. But the second question is very important. So consider a situation where you have a state-sponsored large-scale cyber attack that targets the subset of critical third-party service providers concurrently that provide a significant amount of service to the whole financial system. And in order basically to build resilience against these kind of events, you need to have a dynamic risk assessment. One of the important components of a dynamic risk assessment is you need to be able to risk analyze all the critical third-party service providers, understand your dependency on them, understand basically the interconnections that they have with the broader financial system, and most importantly, understand how this particular shock to these critical third-party service providers, for example, will channel into your services. So the dependent structure, the interconnections, the risk channeling are all feeding into this particular assessment in order to build resilience against a state-sponsored cyber attack. And it could only target, for example, critical infrastructure. It could also target your trading models if you're using AI-driven trading models at a bank or a hedge fund. So it requires a lot of mapping in order to really assess where the risks are, where the risk is.
Thank you very much, Dr. Shannon.
Yeah, so practically, what happens in our clients, for example, we recommend certain systems, software systems, which actually detects vulnerabilities in the IT system, and these are flagged then to the IT risk manager, who then creates a ticket for IT to actually plug the gap. Okay, so from a cybersecurity point of view, that is how we do it practically. But that's not enough. You know, that dynamic risk assessment needs to happen. And COVID-5 gives you the ability to scan across the IT framework to identify those vulnerabilities and those risks. So please, you know, have a look at COVID-5. You'll find a lot of answers in that. If not, come back to me. Happy to answer any questions via LinkedIn.
All right, thank you very much. We don't have time. Like I said, the first two questions have been addressed. So I think with this question, we can say, let's come to an end. Thank you, everyone. Thanks first to the speakers, Lawrence and Dr. Shannon. Thanks to Nancy and Pandya. And thanks to all of you, the attendees. Thanks for listening. And we hope that you really got what you wanted, that you can use in future. Read the paper. And please, we would like to see you again. We are always holding these webinars as the Banking Virtual Forum of the IAA. So we will be having more webinars in future. In 2024 alone, we held about 5 webinars, and that was great. So we look forward to see you again at the next session. Thank you very much. For now, goodbye.
Thank you all.
Thank you.